Okay, this lesson is on credit reports and credit scores. Having a good credit score is much more than getting good rates on loans. 5 benefits of having a good credit score. 1, you can qualify for great credit card deals, low interest, rewards, and cash back. 2, improve your chances of landing an apartment. 3, receive better car insurance rates. 4, lock in utility services. And 5, get a job. So what's a credit report? A credit report is like a report card on how well you manage your finances. What is a credit score? A calculated score that summarizes credit report information. Who uses credit reports and credit scores? Today, companies use the data in your credit report to create credit scores, which most lenders will use as an alternative to manually reading your credit file. That said, you can expect an underwriter to look more closely at your credit report when you're applying for a larger loan, such as a mortgage, or in cases where your credit score is on the fence. So lenders, banks, insurance companies, landlords, potential employers, and you should use them too. Who cares? Well, you should if you care about saving money. For example, the difference in total interest payments on a $250,000 30-year mortgage between 5% interest rate and 8% interest rate is about $179,000. That's the cost of less than perfect credit. We'll watch a short video here.
Welcome to That's What I Thought. Travel to Mars takes 7 months, but you can raise your credit scores instantly with Experian. That's it for
Meet Jasmine. Jasmine is a college student attending State University. Like many college students, Jasmine has seen a lot of her friends and family use credit, whether it's through a mortgage, a private student loan, or simply a credit card. However, Jasmine has always been too afraid to use credit herself, leaving her with no credit history and a non-existent credit score. What should Jasmine do? Well, beyond watching our 2 other introductory videos centered around credit, Credit Cards 101 and Loans 101, her next step is simple. Understand her credit report and score. A credit report is straightforward. It's essentially a detailed history of your credit, covering everything from your payment history to the age and status of your accounts, as recorded by the 3 major credit bureaus in the United States: TransUnion, Experian, and Equifax. As you can imagine, this is quite a lot of information for anyone to process. So, one company actually created a simple way to summarize this information called a FICO credit score. This is a calculated number between 300 and 850 that summarizes your credit report. The higher your score, the lower the interest rates and the better the rewards you'll get from banks. Plus, a high credit score is also vital for a number of other things, like getting affordable insurance, finding an apartment, or even qualifying for a cell phone plan. Ironically, for such an important number, getting your credit score actually used to be quite difficult and expensive, but now we recommend a website that makes it free and easy for you to get your credit score and report online. This is great for Jasmine, but she's still confused about one last thing. What exactly makes up a credit score? Well, a credit score is actually made up of 5 components, and from understanding each one, you can derive the 4 major ways to improve your credit score. Part 1. Payment history, 35% of your score. Because this is such a large number, it reveals the importance of paying every bill on time, even if it's just the minimum. If you're struggling with this, we highly recommend setting up automatic payments for everything, especially your credit card. Part 2. Credit utilization, 30% of your score. To avoid damaging this, we recommend not exceeding more than 30% of your maximum credit line, both total and for each individual account. If you're struggling with this, try paying off your balance early a few times a month, or try asking your bank for a credit line increase. Part 3. Length of credit history, 15% of your score. The existence of this component means, rather counterintuitively, that you shouldn't close out your old credit card accounts unless you absolutely have to, as otherwise you'll hurt your credit score. Part 4. Recent inquiries for credit, 10% of your score. This one's simple. Don't apply for new credit cards and loans unless absolutely necessary, as each credit inquiry will slightly lower your credit score by a few points for the next 12 months. Finally, Part 5. Types of credit used, 10% of your score. Unfortunately, we just don't have a rule for this one, as we don't recommend applying for multiple types of credit just to boost your score. Finally, before we conclude, we just have 2 more things for Jasmine to keep in mind. 1. To build a credit history, and thus a credit score, you need to use credit. And the easiest way to do this is to open a credit card, like a secured or student credit card, that are designed specifically for people with no credit history. And don't worry, we teach you everything you need to know in our 2 videos, Credit Cards 101 and How to Rebuild Your Credit. 2. Be sure to check your actual credit report for mistakes at least once a year, as these errors can dramatically affect your credit score. Should you find one, be sure to contact the credit bureau as soon as possible. Hopefully you and Jasmine now better understand how credit scores and reports work. Be sure to check out our next videos, which cover common mistakes and best practices for credit cards and loans, and be sure to check out our...
What is a credit report? Your credit report contains information that identifies you, such as your name, address, and social security number, and information about your borrowing activity, such as loan applications, balances, and payment histories. In addition to your name, social security number, and date of birth, your report may also contain previous addresses and employment information. Despite all of this unique information, credit report mix-ups are still quite common, especially if you have a common last name like Jones or Brown. The bulk of your credit report contains detailed information about recent activity on your financial accounts. This includes credit inquiries, anytime you apply for credit, whether or not you are approved, open loans. Data will include the bank, the loan amount, the date you opened the loan, your monthly payment amount, and your payment history. Open revolving accounts. These are your credit cards. Data includes the bank, your credit limit, the date you opened the account, your payment history, and the balance on the account as of your last statement date. Closed accounts. Accounts will remain on your report even after they are closed for up to 7 years. Collections accounts. In the event you have a bill sold to collections, this account will appear on your credit report. This can happen even if the original debt wasn't included on your credit report, such as a medical bill. Public records. These include tax liens, court judgments, and bankruptcy filings. And comments. Credit bureaus give you the ability to add comments to your credit report to explain records. Creditors can also add comments. How long does information stay on your credit report? 7 years for late payment, charged off account, collection accounts, civil claim judgments, Chapter 10 bankruptcy, and then 10 years for Chapter 7 bankruptcy and closed positive accounts with no negative history. So a long time. How do I get my credit report? In the United States, the best way to review all 3 of your credit reports is for free is to go to annualcreditreport.com. The U.S. government mandates that all consumers can receive each of their 3 credit reports from this site once a year for free. You are allowed to receive 1 free credit report from each credit reporting company, Experian, TransUnion, and Equifax, every 12 months. It's important to receive all 3, as not all companies report to all 3 credit reporting agencies. You should review your credit report for possible fraud or errors on your account. If you find a discrepancy, report it to the credit reporting agency. So basically, every 4 months, you can get a free report. Get one, in January from Experian, then get another free one in April from TransUnion, and then 4 months later, Equifax. Slide 10. Hard versus soft inquiries on your credit report. There are 2 different kinds of credit checks or credit inquiries. Hard inquiries and soft inquiries. A hard inquiry occurs when a lender checks your credit report after you have applied for a loan, mortgage, credit card, or other type of credit. This type of inquiry will stay on your credit report for 2+ years and can have a negative impact on your credit score if you have too many hard inquiries in a short period of time. Opening numerous credit accounts may indicate that you're having trouble paying bills or at risk of overspending. Soft inquiry is when you check your own credit. Other types of soft inquiries are when you give permission to an employer or landlord to check your credit, or pre-approvals by lenders or insurance companies. A soft inquiry does not involve a credit application, so it does not impact your credit score. What is a credit score? A credit score is a 3-digit number derived from the data in your credit report that indicates how likely you are to repay a loan on time in relation to other borrowers. Different companies produce different credit scores under brand names like FICO Score and Vantage Score. Each of these companies may have several different versions of their score for different end uses. For example, one for mortgage lenders, one for credit card banks, another for car insurance companies. Finally, each of these credit scores may differ depending on which of your 3 credit reports was used to pull the data. There are 3 credit bureaus: TransUnion, Experian with enrollment in Experian CreditWorks, and Equifax. Although most of your credit report will be the same across all 3, there can be differences. %90 of all lending decisions in the U.S. use FICO scores, which range from 300 to 850. In general, however, all credit scores fall somewhere on a range between 300 and 850. The higher the score, the better your payment history and creditworthiness. A lower score means banks will consider you a higher risk customer. If you have a score of at least 700, you'll have the best chance of getting approved for best credit card offers, auto loan rates, and mortgage rates. Scores in the high 600s aren't necessarily bad, but they won't qualify you for all loans or the best rates. With a sub 700 credit score, you could also still be declined for many of the best credit card offers. Finally, it's important to note that once your credit score approaches the high 700s to low 800s, any further increases won't do much for you. Banks will already give you the best rates. It's not like if a professor awards an A+ to numerical grades of 97 to 100. Once you hit 97, there's no additional benefit to getting a 98 or a 99. Okay, so slide 13. FICO's 5 credit score factors: payment history, credit utilization, length of credit history, new credit, and credit mix. A key part of credit scoring is time. It typically takes 3 years of responsible credit use to have an average credit score in the mid to high 600s and up to 7 years to develop a very good credit score of 700 or more. TC's 2 cents. How to get a good credit score summary. Pay bills on time. Your payment history accounts for approximately 35% of your credit score, more than any other factor. Making consistent on-time payments is the number one thing you can do to build a good credit score. Not surprisingly, nothing will wreck your credit score faster than failing to pay these bills on time. The longer you take to pay them, and the more often you're late, the lower your credit score will fall. Avoid high levels of debt. Too much debt is bad for your finances, and it's bad for your credit score too. Your overall debt level accounts for 30% of your credit score. Keep credit utilization low. Credit card utilization, or how much of a balance you carry in relation to your credit limit, affects your credit score. The higher your combined balances in relation to your combined credit limits, the more your credit score will suffer. For the best credit score, you want to keep this utilization ratio as low as possible. Don't cancel old or unused credit cards. Other factors that affect your credit score include the average age of your credit accounts, account diversity, recent credit inquiries, and public records. With the exception of public records, each of these factors make up about 10 to 15% of your credit score. The longer you have had credit accounts open, the better. If you don't have to cancel an old unused credit card, don't. Keep a mix of credit. Your credit score won't be as good as it could be if you only have credit cards or only have loans. Limit credit applications to no more than two every 6 months. Checking your own credit score is known as a soft inquiry and does not count toward this limit. Too many credit applications in a short period of time can cause your score to go down because it looks like you're desperate for credit. There is an exception, however, for credit inquiries of the same nature that indicate you're rate shopping. If these inquiries are within a month or so of each other, they will generally only be counted as one inquiry. So here's, it says here, create a pie chart of what makes up a credit score. Label each with the name and percentage, and then create a table as shown and complete each column. And you could do that with a partner or on your own if you'd like. You can use canva.com if you'd like to do that, or you can use just draw it on a piece of paper. So pause the video and do that now. And you can either submit that through our classroom, or you can just turn the paper in. And finally, for a wrap up here, it's never too early to start building good credit. A good credit history and credit score impacts your current and future well-being. You're going to work on 5.3a credit reports, or some questions to answer there. And then 5.3b credit scores, some questions to answer there. And and then also turn in the pie chart as instructed on slide 16.